Hey guys, what's up and welcome. Today we've got a two-piece. We're going to be hearing from our two favorites. We've got Tom Lee saying markets are dealing with a lot of uncertainty from the rates and earnings and geopolitical. Then we have Jeremy Siegel. He says bonds have proven to be a very bad hedge against inflation. So we're going to get both of their thoughts, as well as I'm going to give some thoughts and opinions. As always, if you guys enjoyed this video, please hit the like button. I appreciate you being subscribed, and let's jump on into them.
Up. We just mentioned all the different things in the mix. The Fed speakers, are those potential market movers?
Absolutely. Markets are dealing with a lot of uncertainty right now because we're in the midst of earnings, which hopefully is better than expected. We've got a geopolitical situation that's uncertain, and interest rates have been creeping up again. So I think markets remain on edge, and I think investors are not that committed. I still think the bias is to the upside, though, because of positioning. Investors really position cleared over the last 10 weeks.
Tom's always the super long-term bull, even when everything's stacked against him. Guys, we've got Tesla earnings coming up, one of the biggest earnings, if you ask me, in the next couple of days. I can't wait.
All right, Tom, in all fairness, you are one of the biggest bulls on the street, so I think you're generally pretty bullish about the market's direction. With that bullishness in mind, what is your WEX word of the day?
So the WEX word of the day is uncertainty.
But why?
Well, it's just, I think investors generally like a narrative that's really clear. And right now there's a lot of multiple narratives in place. But I think that the prevailing story is going to be that this uncertainty clears stocks because investors are sort of not invested. And we're in a seasonally strong period. We're going to rise through the end of the month and into the end of the year as well.
All right, so with this uncertainty in mind, I know you're also looking ahead to retail sales out at 8:30 a.m. Eastern. We're also coming off a day where the XRT retail ETF had its best day since June. What are you expecting from retail sales? And as this report, are we going to add this to the list of market movers?
Yeah, I mean, markets are data dependent, so they're going to look at retail sales. I think kind of on the seat's edge because, you do have a lot of headwinds there. We know delinquencies are up, and we know consumers have student loan repayment resumptions, and generally the employment market has softened on the edge. So if it's a good report, that would be good news. But as you know, futures overnight are a little soft, and I think investors are just waiting to see.
Wait, so Tom, I want to be clear.
That's what I wanted to bring up. If you guys saw the futures this morning, right before the market opened and even right into market open, man, you would have thought we were going to have a really big, bad sell-off. But no, they yanked it all the way back. Some of these stocks are at new highs. Some of them are at a couple percent up. Some of them are back to break even, but they were down percents. I think the NASDAQ and the SPY were down even over 1%. It was ugly. And I went and cut some grasses this morning, came back all the way back up. Missed a couple buying opportunities for a day trade, but what are you going to do?
Clear. So this is a situation where, so-called good news is actually good news. You're not worried that strong retail sales may make the Fed more likely to come out hawkish, or Fed speakers today more likely to come out hawkish? Is this a data point that you think moves the Fed towards a more hawkish turn?
Well, I think the Fed's speak in the last couple of weeks has made clear that they think the rise in long-term rates is doing a lot of the work for the Fed. So they're in the mode that the bar is pretty high for them to actually increase rates again. I think good retail sales would actually be good news because it would show that the economy isn't stalling and headed for a hard landing, but it's sort of supporting that soft landing scenario.
Okay. We are in earnings season. I want to get to one of your picks right now. Not reporting earnings this week, but earnings are certainly coming up, I believe, a week from today. It's Cadence Design Systems. Give us a sense. Why is that a smart pick right now? As you just mentioned, we are in a higher for longer environment.
Well, Cadence is one of the most important companies in terms of helping design high-end chips. They do EDA and systems integration. In this world where there's almost continuous demand.
I've never heard of this company, but that's a pretty good looking chart, I would say, for a long-term investor.
And for AI and shortages of chips, they're one of the key players in terms of designing software, and it's one of the least known. So to us, this is a steady grower with multiples that can expand and very good earnings visibility. I think it's the kind of stock you want to own, especially if you're expecting a year-end rally. And again, it's one of our super granny shots as well.
All right, really quick, I have to ask everybody about this because it's higher for longer. Look at the valuation on Cadence, 46 times forward earnings, even higher than NVIDIA at 35 times earnings. So you're saying you're willing to pay up for the growth potential of this company?
Absolutely, because number one, the company doesn't have a lot of capital investment. It's a software company, but with improving visibility, a great capital structure, and kind of an enviable position. I mean, they're really one of the handful of companies that provides the software. But again, really good visibility, high operating leverage.
Got it.
And it's not well known, so it's a stock that I could easily see multiples expanding.
All right.
What a crazy guy. He wants to pay 45 times for a non-magnificent 7. I don't get it, Tom. That's one of your crazy calls right now. I'm not agreeing with that one for sure. Let's get into what Jeremy Siegel has to say, and he's going to give some evidence on how the bonds have proven to be a bad hedge, which are supposed to be known to be a good hedge, but it's obviously not working that way.
Broader markets, our next guest says that he likes stocks right now and thinks that equities are poised for a year-end rally. Joining us is Jeremy Siegel. He's professor emeritus of finance at University of Pennsylvania's Wharton School of Business. And Professor Siegel, first of all,
before he gets into it, I wonder if you guys saw the gentleman earlier this week that was calling for bonds as not really the new allocation. He's calling for 80 to 100% in equities, and that was a pretty big call. It got a lot of views. Let's see how Mr. Siegel has leaned towards that.
well, thank you for being here. Let's talk through your thoughts on this. Some people think, oh boy, we were due for a much bigger pullback. We've seen the pullback, and you think it's over. You think it's uphill from here, that equities prices are on the rise. Why is that?
Yes, let me tell you why, Becky. A lot of people say, look at how much bond yields, aren't they real competition now for stocks? First of all, stocks are selling for 17 times next year's earnings. If you take out the tech, it's like 14 or 15. If you go to small caps, it's 11. And I know there's reasons why, but those are very low valuations. But more important,
I think the long-term average with tech is like 16 or something, so it's still a little high, but it's definitely come down.
importantly, why have bond yields risen so much? It's not just the Fed. It is faster growth than anyone thought. That's good for stocks. Promise of AI. The third quarter is going to be a real strong figure, and I don't see really any real weakness in it. But more importantly, and I think this is a major reason, bonds have been harmed by proving to be a very bad hedge against inflation. I mean, bonds are great hedges against geopolitical risk, against financial crises, but they're very bad against inflation. We didn't have inflation for 40 years, so everyone sort of forgot about that bond, bad inflation outcome. And then suddenly, after the pandemic, it reared its head. And when we look forward the next 10, 15, 20 years, people are saying, you know what? There may be more inflationary episodes. Do I really want to be in bonds?
I understand his aggravation. It's similar to how I feel. We only acknowledge news when it's trying to scare people and when it's bad. And then when it's all of a sudden, it can just be forgotten in an instance and replaced. And as long as whatever the media is covering, hedge fund leaders and all this, they have so many theories out there for both sides. And they choose to pick which news is going to support each side and what's going to be relevant and what's not going to be relevant and what's baked in, what's not baked in. And it just depends who you listen to. Honestly, that's why it pays to be a long-term investor. There's too much of this back and forth all the time.
And we know stocks are real assets, just like real estate are real assets. And I think that's one reason why people have shifted. So bond yields, yes, have come up to be sure, but that's because they've been damaged as being seen as the ultimate.
That 2-year note's over 5.1 right now, the 30-year. Oh man, creeping up on 5%, folks.
Hedge against stock risk.
Professor, let me ask you a question. Maybe I'm just not understanding this. If you think that there could be more inflation to come, that means that rates would go up even further still, and that's been a big issue. Every time yields go up on the Treasury market spectrum, you watch equities come under pressure, just as people get concerned. And again, they look to this as being, maybe if you think there's more inflation, that yields will go even higher. That's why bonds are a bad place to be, but ultimately that could be bad news for stocks too.
Well, I think actually inflation's on its way down right now. But Becky, stocks in the long run, and I've done all that long run data, are excellent long-term hedges. You're planning a 10-year portfolio, a 15, 20-year retirement portfolio. Stocks do beautifully against inflation. Bonds.
25-year-old investor here, guys. We've got a long time to go. Let me know how old you are down in the comments, guys. How many years do you have left
Do not.
to invest? I guess that was a weird question.
So, yes, I think inflation is going down right now, but when we look ahead at the deficits and all the rest, could there be another inflationary episode? And then what do I want to hold? Do I want to hold real assets or do I want to hold paper assets?
And on top of that, do you want to hold stocks or bonds? Even, let's take it back and just say the safety stocks, guys. Dividends and safety stocks have been crushed. So you've been out of the market, not getting the gains from the mega caps, while now getting crushed just as much, if not more. It's not making sense anymore. Everybody's concentrated in the mega caps, and they're going to be a self-fulfilling prophecy, if you ask me. It's just going to keep going. It's going to be able to weather every storm because it's the best place to put your money anywhere. Unless these rates keep going up and we get interest in savings accounts paying 6, 7, 8%, where it's just a no-brainer, where we start getting near what the S&P 500 yearly gain is. But man, I'm hoping it's not going to get that bad. And even if it does, these stocks have money and they will change, and then it might be hard for a couple of years, but they'll be set up to weather that, and it should get easier over those next 5 or 10 years, and then they'll just be set up even better. So these are some of the best companies in the world, guys. I bet on them with my money.
And
Professor,
I think that's one of the reasons why those yields have gone up.
You're 100% right, at least historically, that over a 10, 20, or 30-year period, that is the case. The question that I'd ask is, let's say you're in a different situation and you're looking at your accounts and the balances matter for the next decade. Let's just make it a decade. What do you think then?
I would still be in stocks. I mean, you're talking about 10 years.
10 years. 10 years is the.
If I think there's going to be some more, I think rates are going to come down, but maybe 3 or 4 years hence, there'll be another little episode of, 6, 7, 8%. Do I want to be in paper assets? Do I want to be in real assets? Don't forget, we had 40 years. I mean, from basically 1980 when we came down after Volcker all the way until the pandemic, where we really didn't have an inflationary episode. And that's one reason why bonds kept on going down, down, down in yield, because people said, oh yeah, they're great hedges against pandemics, but anything that you want except inflation. And people forgot about that. They thought the Fed would never let inflation go this bad, and now they're not as confident about that going into the future. 10 years for me is enough time. I want to be in real assets.
I agree.
Amen to that, to the fullest extent. I don't own any bonds. I'm sure a financial advisor would recommend against that, but I don't want one. I don't need one right now. I'm doing all right.
Agree with you, so I have a hard time arguing and playing devil's advocate in this, Jeremy. But let me tell you about a couple other arguments that have been thrown out just in terms of valuations for right now. There are those who say, look out, we are at very high valuations given some downturn that's expected to come. How much of what you're predicating your thesis on is that we'll have a soft landing and that there's not going to be a big downturn?
Well, soft landing probabilities have definitely increased. It's interesting. If we have a recession, I think stock prices will go down. But one thing has always been true. They go down too much in recessions, and they prove to be unbelievable buying opportunities. People get really scared, and then once that, and listen, we've gotten out of every recession the last 200 years. We'll get out of the next one, and then we see soaring. You're planning a 10-year portfolio? I wouldn't worry about a recession. If you're a timer and you think there's going to be a recession, I'd wait. But you have to decide what are you going to play that game or not? You know how hard it is to play that game. I rather, concentrate on long run. And as I said, 17 times earnings, and that's including all the tech. X-Tech 15, 14 times earnings.
Guys, I love that. I love what he just said. We've been through recessions. We've gone through them. We will always get through them, and we will keep making new highs, guys. That is what I choose to believe as well. And on top of that, people get over fearful. They get way too scared, and they start giving us the best companies in the world for the craziest bargains out there. So if anything, you've always got something to look forward to. You always got to keep some powder dry, always keep some money coming in. And as long as you're properly diversified, guys, you welcome a pullback. You get those companies you love at a little bit cheaper price for the long run, throw them in the filing cabinet and call it a day. Call yourself rich in 5 to 10, 20 years, man. 10 years, he said he wouldn't worry about it. Look at the last 10 years. Even people calling for maybe a different 10 years than the last 10, 15. I don't think so for the mega caps. I don't think so with AI. I think it's going to be a game changer. It's going to be a revolution, and it's going to be hard to slow down even with all of this negativity and stuff that's against us. Anyways, I hope you guys enjoyed the video. Hit the like button if you did. Lets me know. And I will catch you guys in the next one. Thanks for watching. Peace.